Hi everyone. $10,000 in a tech fund turned into $83,000 over the past decade. That same $10,000 in a boring dividend ETF became $33,600. Here's what Wall Street doesn't want you to know. When tech crashed 30% during the last bear market, the dividend fund dropped only 3%. Institutions rotate between these two funds like clockwork, capturing 700% gains during bull markets and protection during crashes. Most retail investors pick a side and lose massive returns. The second position I reveal returned 731% in 10 years. But if you're over 50, holding it alone is financial suicide. The third strategy shows you the exact allocation by age that captures gains from both sides of every market cycle. Here's what kills most investors. They think they're either a growth investor or a dividend investor. Pick your team, ride or die. That's complete garbage, and it's costing you hundreds of thousands of dollars. Markets move in cycles. Growth stocks dominate for 3 to 4 years. Then something breaks. Suddenly, institutions rotate into value stocks and dividends. During the last correction, the S&P 500 dropped 18%. The Nasdaq down 33%. But SCHD, the Schwab US Dividend Equity ETF, dropped only 3.2%. That's the difference between staying retired and going back to work. But wait, while growth investors were licking their wounds, dividend-only investors missed the entire tech boom. From 2017 to 2021, growth stocks returned over 200%. Dividend stocks barely moved. If you were 100% in dividends, you left life-changing money on the table. If you're over 50 with everything in tech stocks, you're playing Russian roulette with your retirement. One bad cycle and you're working 5 more years. The first position in SCHD, and I'm calling it the rotation shield. This fund outperforms when growth stocks get expensive and investors shift to safety. SCHD tracks 100 US dividend stocks with ruthless screening. Companies must have 10 consecutive years of dividend payments, low debt, high return on equity, and strong free cash flow. Cut your dividend, you're out immediately. SCHD holds exactly what institutions buy when de-risking. Energy companies with 8% free cash flow yields, healthcare giants with bulletproof balance sheets, industrial firms and financial stocks. The expense ratio is 0.06%. You pay only $6 per year for every $10,000 invested versus 0.75% for actively managed funds. Over 2 decades, that fee difference adds tens of thousands of dollars. Here's the power. $10,000 in SCHD a decade ago grew to $33,600. That's a 236% total return or 12.9% annualized. You tripled your money while collecting growing dividend checks every quarter. The current dividend yield is 3.6% to 4%. On a $100,000 position, that's $3,600 to $4,000 per year in real income. When the Nasdaq dropped 33%, SCHD dropped just 3.2%. If you're retired and pulling income, that difference is everything. But here's the critical warning, and this is where most dividend YouTubers lie to you. SCHD is not a growth engine. If you're 30 years old with 35 years until retirement, and you put 100% in SCHD, you're leaving massive gains on the table. From 2017 to 2021, the Nasdaq returned over 200%, while SCHD returned about 80%. SCHD is the shield, not the sword. You need both. And if you're under 45, you need a lot more sword than shield. The second position is the growth accelerator. This is what you hold during bull markets when innovation drives returns. For balanced exposure, buy VOO or VTI. These track the S&P 500 or total US market. For pure growth, you want VGT, Vanguard's Information Technology ETF. This holds Apple, Microsoft, Nvidia, Amazon, Alphabet, Broadcom, the AI winners, the semiconductor leaders. Here's the math that will blow your mind. $10,000 in VGT over the past decade grew to $83,100. Read that again. $83,100. That's a 731% total return, or 23.3% annualized. You multiplied your money by 8. But look at the downside. In the last bear market, VGT dropped 29.7%. In 2008, tech dropped over 40%. If you're 60, you need that money in 3 years. A 40% drop is catastrophic. You don't have time to recover. This is why the allocation I'm about to show you is critical. When growth is running, VGT captures 730% returns. When crashes happen, SCHD protects you and pays dividends while you wait for the next cycle. Let me say something controversial that's going to make the dividend-only crowd furious. If you're under 50 and you invest 100% in dividend stocks because you think it's safe, you're committing financial suicide. Here's the brutal math. SCHD returned 236%. Fantastic. But VGT returned 731%. That's a difference of 495 percentage points. On a $100,000 portfolio, that's the difference between $336,000 and $831,000. You just cost yourself nearly $500,000 because you were scared of volatility. You had 30 years to recover from. Now, before the growth-only people celebrate, here's the truth for you too. If you're over 55 and you put 100% into tech stocks, you're gambling with money you cannot afford to lose. One bad cycle wipes you out right before retirement. The answer isn't picking a side. The answer is owning both and adjusting based on your age. The third strategy is the exact location that wins during both cycles. I call it the cycle-proof allocation. You don't know when rotation will happen, so position yourself to win either way. Ages 30 to 45, 30% SCHD, 50% VOO or VTI, 20% VGT. Young enough for volatility, smart enough to have a shield. Ages 45 to 55, 40% SCHD, 45% VOO or VTI, 15% VGT, reducing growth as retirement approaches, but still 10 to 20 years for compounding. Ages 55 to 65, 50% SCHD, 35% VOO or VTI, 10% VGT, 5% bonds. You cannot afford a major drawdown before retirement. SCHD's dividends start replacing your paycheck. Ages 65 and older, 60% SCHD, 25% VOO, 15% bonds. Capital preservation and income are everything. A 30% crash at 70 destroys retirement plans. Here's the logic. During growth cycles, VGT and VOO capture the boom. During rotations, SCHD protects you. Over the full cycle, you earn strong returns with far less stress. The strategy is simple. Markets rotate between growth and value. Always have, always will. You cannot predict when, but you can position yourself to profit either way. SCHD is your rotation shield. VGT is your growth accelerator. VOO gives you balanced exposure so you're never completely wrong. 3 funds, allocate by age, rebalance once per year. Stop timing the market, stop chasing last year's winners, stop listening to YouTubers who will tell you to go all in on one side. Both strategies leave money on the table. I research market cycles every single day so you don't have to. If you want to know which Fidelity fund replaces these Vanguard ones, or how to build a tax-efficient dividend portfolio in a Roth IRA, check out my next video. Subscribe so you never miss strategies that actually work. The next rotation is coming. The only question is whether you will be ready for it. This content is educational and not financial advice. Any investments carry risk, including potential loss of principal. Consult a qualified professional before making decisions. This is Invest ED, building wealth the boring way that actually works. Smash that like button and subscribe for strategies Wall Street won't tell you. Smart investing, profitable results.